Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app.
Going to get it right today, people, because EYT is there. Dan Nathan is there. Swizzle also in the middle box, like Paul Lind on Hollywood Squares. It is 1 o'clock on the East Coast, February 5th. As I said yesterday, like the month is flying by. By the way, Dan, if it's Wednesday, it's Butters, bitch. Yes, it is. Yes, it is. I'm excited about that. Elizabeth, how are you?
I am fantastic. I just saw an alert that coffee is up. Big supply issues with coffee. We're going to have a caffeine problem in this country pretty soon.
Well, you know, we don't rehearse these shows. I think it's crystal clear for those that have been watching all these years. But you mentioned something, I think, you say it in passing, but, the CRB index, which is a much differently constructed index than the GSCI, for example, is making 15-year highs on the back of some of the things, one of the things you just mentioned and some of these other things. So I only bring that up because you brought up coffee, but, below the surface, all the components that are inflationary are trading as if they are inflationary. But, it's a good place to start, Dan, because with that said, you have 10-year yields below 445. I think they're 442 or so, and it's the lowest we've seen in a while. And we have an uptrend line in yields that we can show real quick because, I think this is a bit of a story here. You've been talking about the potential breach of that trend line. Well, it's happening. One has to wonder, if we get all the way back down to the moving average 200-day, which comes in around 4.25 or thereabouts.
Carter says this all the time. I'd love to get Liz's take on this too. And sometimes it's just like kind of market mantras, like, you know what I mean? They kind of take over. They are the thing that a lot of market participants feel pretty comfortable getting behind because it seems like it's sort of a consensus call, if you will, without a lot of nuance. And, Carter said this back, maybe Amanda can pull up a 5-year for a second here. Last time we saw yields, we can go back a year, they were 470, 465 or something like that. But we were all talking about getting to this 5% mark. It seemed like an easy one. But then there's nothing easy in the markets here, right? So the last time we were at 5%, it was higher for longer, higher for longer. Rick Santoli came, or Santelli or Santoli? Santelli.
It's Mike Santoli.
Yeah.
And Rick Santelli.
That's right.
So Rick Santelli was on our show, guy, right around that time when the 10-year cut kissed 5%. And he was talking about double-digit, 10-year yields. And you saw what happened. Now, it didn't get absolutely destroyed, but here we are now. It was some of the same sort of, kind of language, if you will, and same sort of, listen, this doesn't mean anything at the end of the day. Let's go back to that 1-year chart. But you see that rising 200-day moving average. You see where is that? Like, it's 3. Like we could easily be back at, 4 and a quarter or something like that. And then what does that mean for stocks, Liz? If we start seeing yields going lower and, it goes back to when we saw, the Fed funds rate going lower and we saw what happened in the fall, with the 10-year yield.
Yeah. So, I mean, this drop in the 10-year today, we're about 11 basis points below where we opened, 10 basis points, depending on the second that you look at it. And a lot of that drop was due to weak services PMI. We had some weak S&P PMI. There was a weak data that came out from the economy, but the strong part that came out, we also had some payroll data that came out that was interesting. But when you ask about what this does to markets, I'm looking at this, and I've talked about this before. I keep a list of ETFs that I track, and it's mostly broad ETFs, but we've also got some sector stuff in there, some industry group stuff in there, and then some treasury ETFs. I'm looking at the top performers today. And on that list, we have both semiconductors and TLT. That doesn't usually happen. Mm-hmm. Why would you be buying semiconductors and TLT? Also on that top list, we've got cybersecurity and utilities. That doesn't make sense. We've got gold up there. We've got REITs up there. So I think some of this reaction in the market, some of it's a little bit risk on, growth on, but the rest of it is still very trepidatious, very confused about what this means for a pro-cyclical environment. And I'm just going to quickly read a tweet that I saw earlier today. I'll just read the first couple sentences of it. In the final quarter of 2024, when Trump won the U.S. election, buying by central banks the buying of gold by central banks accelerated by 54% year on year to 333 tons. So that's, I think, the third year in a row where we had over 1,000 tons of gold bought by central banks. And that in and of itself tells you that, yes, of course, yields matter. Yes, of course, pro-growth matters. Yes, of course, policy matters. But we've got central banks around the world that are worried about currency, that are worried about reserves, and that's not going anywhere.
You are speaking my language, sister. I love that. And by the way, that's 3 consecutive years. And obviously, they're buying the same amount of tons, but the price has gone higher. So the outlay, by definition, has been higher. And real quick, I don't want to get bogged down in yields, although I do think it's interesting. If Amanda can throw up a TLT chart, a longer term one, you can draw a downtrend line, which is obviously the inverse of yields from the September high of last year. And if my eye does not deceive me, you're probably right at an uptrend here. So the same way that if we were to break the downtrend, which you saw, Dan, the same way if we break this sort of up, there you go, Amanda, look at that. Now draw that from that top and you'll see what I'm looking at. Look at me. Dan, will you look at me? That's what being in the business for 75 years will do. You can look at it and you just know that there's a trend line. So we're right up against the uptrend, which means, if we break this uptrend, yields continue to go lower at 92.70 in the TLT, probably gets you to that 4.25 level. That's how I play this game, Dan.
Yeah, and Guy, yesterday we detailed a trade idea using options in the SPY, either as a hedge or an outright bearish bet. We were talking about a VIX that was below 17. We were looking at vols on the SPY. They looked really cheap, right? So the question I have is that if we do see yields going back towards that 200-day moving average, possibly 415, what does that mean for stocks? And that's how we started this conversation. You see the S&P really hanging out here. It made that brief new high. We kind of sold off fairly quickly. That was a week and a half ago, 2 weeks. Then we had Monday's sell off. Are lower yields good for stocks? Who knows? I mean, we're coming out of this earnings season, and if we're just going to take today as a snapshot, what AMD had to say, and no one had high expectations for AMD, but the fact that the stock was down 10%, right? There was obviously high expectations for Google, and you and I talked about that yesterday. We like the hurdle that they have to cover with the stock at an all-time high, right? Given what we thought were headwinds to that cloud business, and headwinds as it related to that CapEx number. My takeaway on the CapEx number, guys, so it was expected to be like low 50 billion for the year, and they came in at like high 70 billion or something like that. So it was like 20 billion more than expected, which is a huge percentage increase. That was damned if they did, damned if they don't. You know what I'm saying? Because with that weakening cloud number, if you had basically, CapEx that was lower than expected, that would have been a problem. The fact that they seem to have to jack that number up huge, it seems like they're running scared a little bit. So I think we've reached a different point in the trade, which kind of, and I know we're going to hit the semis and this stuff in a second, but Liz, this brings me to a chart that Amanda made. This is the, market cap weight of the S&P versus the equal weight. And just look at this spread right here. And the thing that is kind of sticks out to me a little bit is that we're seeing Microsoft, we're seeing Google, we've seen NVIDIA kind of give up a little bit of the fateful 8. And I guess the question to you is, do you expect that those two lines to meet in the middle at some point?
Yeah. So not only look at the spread, but look at where it dislocated, right? Look at December. So we obviously had big moves in the market post-election, but then in December, we hit the skids a little bit, and you saw the equal weight really take it on the chin. And that's when a lot of the mega caps came back in. People went back into them as if they were the staples of today or the defensives of today. So do I expect these two lines to meet? Well, if we look, even at that chart that Amanda has put together, they don't meet very often, but I do expect the gap to narrow. The bigger question is, how does it narrow? Does the blue line come down, or does the pink or purple, magenta? I don't know what that is. Or does that line move up? I think the blue line probably comes down. And part of that is this rotation that we continue to see at certain times in the market. I'll talk about some of this in my note later, but the rotation that we continue to see as people start to get nervous about valuations, or we have earnings that come in a little softer than we expected on mega cap tech, or we've got CapEx issues on mega cap tech. That's when you see the rotation under the surface, which would drive that pink line up and the blue line down, because the rotation beneficiaries are things like healthcare. There's some of the cyclical sectors, financials, materials. So you do see that equal weight come back in. But the math of this is what continues to trouble everybody, in that you need a lot of that equal weight index to do really well in order to make up for what's been happening in the market cap weighted index. So for those lines to meet, there are a lot of companies that really have to put up strong results.
Yeah, and to me, and by the way, Amanda said that it's fuchsia. It's a color.
That's true.
She's just just to sort of button that up. But if you go back to, for example, if you look at what's going on last summer, you saw a similar dichotomy, a similar divergence between the two, which was rectified obviously on August 5th. But to Liz's point, it was rectified with the S&P cratering. Now, equal weight did as well, but not to the extent. So if you are to believe that they will sort of get back into equilibrium, chances are that's the way it's going to play out. And real quick, if you go back to Google, and I don't want to get bogged down, a couple things stick out to me here, Dan. In this environment, you got to not only beat, but you have to say things that are encouraging. So if you're in line, or even, God forbid, if you guide lower, you're going to be punished. And I think to a certain extent, that was Google's story. And what we thought, and again, this is not Monday morning quarterback. Carter's right a lot more than he's wrong. But, I saw that gap in the chart, Amanda. If you can get into a non-static chart, you can see what I'm looking. Yeah, there you go. So that gap that was created back there, and you put your cursor on it, whatever that high is that day, that's where I thought we'd go back down to. So 176 or so. I mean, that to me is we fill that gap, and then we'll have another conversation. And by the way, Dan, that'll line up with the 200-day moving average.
Yeah. Again, you and I, we might be cautious in the face of a move like that. And just because sometimes you get the fundamentals right, you don't get the price action right. And so, I could not kind of come up with a scenario why Google was rallying into that number, especially what we heard or saw from DeepSeek, and especially what we saw some of the knock-on effects in the tech space, specifically NVIDIA. Guy, one of the things that we just thought was really the most interesting thing that I see in the market today, okay, fine, yields are pretty interesting, but given the way Google is trading, given the way Microsoft traded last week after its result, Amazon is down in sympathy with Google. They report tomorrow after the close. That AWS number is going to be, massively in focus, plus what they have to say about CapEx. But look at how NVIDIA is trading today. Look at how Broadcom is trading today. Look at how Marvel today. So, Google is being punished for that CapEx. Those stocks are benefiting RM2. And so this is one that, I don't know, man. It's about as clear as mud, because last week when you saw NVIDIA close down 17% on that DeepSeek news, all these names were down in sympathy. And now it seems like these names win either way, right? But I guess the one thing I'll say about Broadcom and Marvell in particular is that if you do see diversification away from NVIDIA chips, it's going to those who create custom silicon for the likes of Microsoft, Google, Meta, and XAI, that sort of thing. So interesting setup here in the semis.
Yeah, they win today, to your point, and I have NVIDIA up on my screen. I was looking at the same thing you're looking at, and I think we got down to, if I'm not mistaken, about 116 or so. So it's a nice little bounce off those recent lows, but I think that's all it is. And I get people excited about the added spend here, and they think, okay, NVIDIA wins to this, but all we've effectively done, I think, is get right to this moving average, which is still sort of flattening out. Now, people will say, you know what? We're going to rally into earnings, because regardless, that's what typically happens. People don't want to be sort of caught off guard. And before you know it, we're going to be talking about NVIDIA earnings in a couple of weeks. But we'll see. I still think that engulfing pattern that we have talked about ad infinitum is holding up like a champ. And I still think there's some downward pressure to come.
All right, Liz, this is I guess one of your favorite charts here. It's not your little Russell 2000 or anything like that, but you've been tracking semis versus software. And one of the things that was really interesting, because we know that semis was such a big outlier for the last kind of right up until, I want to say, Q3 of last year, and prior to that for like 18 months or so. And a lot of that was driven by NVIDIA. It's still just a striking number that 25% of the S&P 500's gains last year was NVIDIA itself. But software kind of caught a bid in Q4 a little bit. Semis kind of got stuck in the mud. How are you thinking about this? Because more and more analysts that we talk to, whether it be on our podcasts, whether it be on Fast Money, they're talking about the next beneficiary of this generative AI trade being enterprise software. And so I buy that. We hear a lot from Oracle. We hear a lot from, Mark Benioff from Salesforce. We did have a disappointment with ServiceNow about a week ago. It's down 10%. 5%. I guess they did not see the sort of growth in AI that they had guided to prior. So how are you thinking about this? Because I guess there's going to be winners and losers, especially out of the gate. And so far, there's just a few winners in the enterprise software space.
Yeah. So, I mean, even if you just look at the crossover of these lines, right? Software takes over in November, but the ride in software since then has been a lot bumpier, a lot more volatile. So if you were in software for that entire time, you almost lost everything that you thought you gained into December. So it's been difficult to hold on to, but my thesis for 2025 still remains intact. And I'm staying steady on this. And I would call it a three-pronged thesis. The first of which is that I think software benefits from a rotation of CapEx dollars. We know that CapEx has been under scrutiny in the semiconductor industry, and from just AI specific names, I think software becomes a beneficiary of some of those companies pulling back and being more careful about announcing that CapEx spend on semiconductors in particular. The second piece of it is I do think that they are the next phase. So basically what we said in the outlook is that software is the conduit for what puts a lot of these ideas into life at companies. But that doesn't happen overnight. And it has to go through an entire enterprise software cycle. It has to go through a CapEx cycle. It has to go through a period of time where the companies have proof of concept and then they implement, and then it creates revenue. But first it creates cost. So that's a big piece of it. And then the last piece that I've thought for a while, and this was maybe even middle of last year, I started talking about this, is that cybersecurity falls under software. And I think that that can be another tailwind. That's just a long-term theme. I mean, we're certainly not losing demand for cybersecurity software. So that's a piece of it that you can even buy specifically that would fall into the software industry group, but is a more specific chunk. I actually own them both. I own a broad software ETF and I own a cybersecurity ETF.
Dan, do you like going to the zoo?
Yeah, why wouldn't I?
What animals? I mean, people have their favorite animals. I know, for example, I like to go see the grizzly bears.
Yeah.
I like the polar bears.
By the way, I was gonna say grizzly bears or lions.
Yeah, lions are badass.
But I'll tell you this:
cats, the tigers.
Yeah, I love that. But if you've ever seen, you hung around elephants too long there when you're watching them move around, at some point something's going to happen, and you do not want to be at an open fence around that. You want to be. Liz is shaking. You know what I'm talking about.
Oh yeah.
Because it's not pretty. Guy, where were you going with that?
Funny you should mention elephants because they apparently are an animal with a great memory. I probably share that with the elephant. That's probably the only thing I share with the elephant, not to get too graphic, but it was in the spring into the summer of last year where Elizabeth was talking about how she favored software. And if you go back to that chart quickly, you'll see, I mean, the timing was impeccable in terms of, what we were talking about. And that sort of, they bottomed out, I think, in August, and they've been sort of on the move ever since. So, I do pay attention. By the way, the other thing I do is look at the questions we're getting. And Adam B is asking, I'd like Guy's take, I don't know why me, on the XLC. That's the communications ETF, which is probably at an all-time high. If memory serves, I think it's mostly Facebook. I think it's probably 20% Facebook. Google's probably 10.5, 11%. And then you get into some of the other names like Netflix and T-Mobile and those types of things. So basically, if you're bullish here, you're basically saying, I still like Facebook. I mean, that's, to me, it's a Facebook play with sort of a Netflix tail. Obviously, Google's a component as well. I still like Facebook here. There's nothing to indicate that Facebook's going to be derailed anytime soon, in my opinion. So I guess my answer to you, Adam B, is to sort of stay with it here, Dan.
Yeah, that's just a really shittily constructed ETF. If you think about it, 20% Meta, 20% Alphabet. Then you got Netflix at 7%, and then it's AT&T, T-Mobile. I mean, like, it's just a bunch of like random shit in there. You know what I mean? Oh. So I think there's probably easier ways to kind of play this. And I don't like Meta here. I like the fundamentals are fine, the valuation's fine. I just think that what's happened over the last couple of weeks, I just think that they're going to have a check back to that breakout level. You can see it right there. So as far as I'm concerned, 640 is in the offing. I'd say, where is this thing right now? 720 or something like that. 705. I'd say the next 50 points is down rather than up. I just want to make one point. I had Rishi Jalaria from RBC. He's a software analyst on the Risk Reversal pod this morning. It should be in your podcast store. He covers the software space. We spent a lot of time talking about Microsoft, Oracle, Stargate, all this sort of stuff on the CapEx front. But we were talking about some areas away from hyperscalers that are probably the next leg of this. And he gave me a few names. Intuit was one of them. So a lot of these kind of consumer-facing sort of names. You already saw this in Duolingo. You remember that stock last year? This is the app that people learn foreign languages and
I'm Duolingo.
I know you are. But like there's a lot of stocks that don't act particularly well. And if they are really good stories about how they're going to use generative AI, I mean, I think there's there's time to kind of roll up your sleeves and figure some of this stuff out. So Liz, what do you think about the notion that, okay, the hyperscalers, they overbuilt, possibly they bought the chips, they bought the memory, they bought the servers, you know what I mean? They made the data centers, and then we really need to see use cases, right? We need their customers doing this, and then we need to see some of these customers be able to got to integrate these services, this technology into their offerings, and then get better uptake or better productivity or whatever the heck it is, right?
Yeah.
What do you think of the next leg of this, being in healthcare, being in financial services, you know what I mean, that sort of thing? Is that make sense for you as we get into this digestion phase and really start to think about the use case phase?
Yeah, and to be fair, I do think that companies are coming up with the use cases. I mean, we see the prompts all over the place, right? I log into my Google suite of products and I get a prompt from Gemini. It can help me with X, Y, and Z. It's happening, right? They're coming up with the ideas, and I do think that they're moving along. To put it into other sectors, though, first of all, we talk about CapEx so much. Healthcare doesn't have as much cash laying around for CapEx. So the first step of this, I think, to really get it to be broadly adopted across sectors and across industries that maybe we don't quite understand the use case for yet, is that the cost structure has to come down. They have to be able to afford to put it into their business before they can actually build productivity and see the other side of it, especially in industries, and parts of healthcare would apply here, in industries that rely on government spending and rely on some of that, the subsidies that they get in order to run the business. And they're more regulated. So there's all kinds of different considerations. Some of these industries are just going to take longer. And that's why I usually talk about AI. This is a years-long theme, and we just don't understand all the use cases yet. That doesn't mean that it's not going to happen. It's just going to take a long time. And I think it's going to have to morph quite a bit over that period of time. And the DeepSeek thing was just the first flavor of the competitive environment changing and a new idea coming out that does have a different cost structure. I think we're going to continue to see things like that evolve and iterate on this entire theme as we go.
It's interesting, we're mentioning AI here, and we do not have a chart of the day. We have a call of the day, which we will get to, but there are a few people saying, hey, Johnson, that's directed at me, your chart of the day should be Walmart. So we didn't do the fancy graphics, but we can put up a Walmart chart, which got above 100, I think, for the first time ever today, making a new all-time high. Now, if you want to be concerned, a couple standard deviations away from the 200-day moving average, which historically is no bueno, but man, oh man, there's a company that AI is absolutely helping them on the margin front. And I think, just my opinion, Dan, the reason they're getting the premium valuation, or even more of a premium valuation now, is because of their ability to sort of harness this AI and have it be accretive to the bottom line. So look, I understand why people would say, man, oh man, it's getting expensive here. As you guys just said, we're getting a couple standard deviations away. You got to pull the ripcord, but there's no indication to me that Walmart's going to be derailed anytime soon.
Yeah, maybe Amanda can pull out a 5-year chart, and we're talking about, I guess, until it broke out. And I don't think when it broke out, in early 24, it had much to do at the time with how they were kind of integrating, some of this technology to, whether it be logistics and, the acceleration that they saw in their e-commerce business. But go back and look at that gap in 20, I guess it was mid 22, right? They had huge inventory problems, supply chain issues and all that stuff coming out of COVID. And it's pretty fascinating, what's happened, here. This doesn't make any sense to me. I mean, this looks like, they cured cancer, or, you know what I mean? Like they sell the GPUs that go into the servers that train the models and, all that sort of stuff. So Liz, when you see this sort of outlier, and maybe they could pull up Costco too, it's just getting to a point where, we saw this in late 99 into early 2000 when what they called bricks and mortar or old economy stocks joined the party because all the benefits that they were going to get from the internet. It just doesn't feel that different to me.
Yeah, well, these charts are tough to look at if you're trying to get into these stocks right now. I mean, you see something move this quickly from bottom left to upper right, and it's like, oh gosh, it looks expensive just from that line. I think that this, and one of the comments that we put up from a viewer mentioned it. I think that this chart and the Walmart chart is indicative of the fact that, yeah, inflation's come down, but the prices haven't really come down, and people have rotated and they're being more careful about where they're spending money. And I think we probably all have an anecdotal story about that. I mean, for example, I recently had to put new tires on my car, and I considered getting a Costco membership just to get the discount on the tires that they would sell. I was going to save maybe like $450 and have this membership for an entire year because I could have saved that money. I think I'm not the only person making those kinds of decisions, right? And I think a lot of people, no matter the income bracket, are starting to spend their money at certain places and watch their pennies because they're getting pinched. So far, consumers have absorbed the inflation and not taken their spending down. And I think some of these names have been the beneficiary of that.
Dan, have you ever changed a tire?
Yeah, of course.
I say it.
I mean, you look at me like I'm not handy. You know what I mean?
I mean,
but by the way,
Elizabeth knows how to change the tire.
I had to get new tires for my car in September, and I was absolutely floored of what they charged. I wish I was near a Costco because I hadn't.
I'm not near one either. That's what I mean. I was going to drive out of my way, join just to get the discount on the tires. It's not even convenient.
All right. To be fair, guy, I haven't changed a tire in probably a couple decades. But go ahead. I have a AAA membership, which is pretty.
No, useful. Can I? Okay. Here we go. Bill Hockman, I hope you're listening to this because this is factually true. If you're driving right now listening to us, by the way, thank you. But if you're somehow behind some asshole with a AAA sticker on his or her car, prominently displayed in some proud fashion, like, look at me, they are the shittiest drivers, bar none, on the road. So if you were to see said sticker, stay away. Give that American, as they say, a wide berth for you Hunt for Red October fans.
Wait, but guy, can we just go around the horn really quickly? Favorite bumper sticker, right? You're driving along, you see one that just makes you kind of chuckle a little bit.
My favorite bumper sticker. Okay, my child is an honor student at something elementary school. Who gives a blank? I don't care. You know who else doesn't care? Your kid doesn't care.
Well, hold on.
No, it's just true. Like, I don't care. Baby on board.
Okay.
That's great. I mean, are you warning me? Or there's going to be projectile vomit coming out the back? Yeah. I mean, am I supposed to drive better because I know there's some baby on board? Why don't you just put asshole on board? I'm more apt to sort of drive better that way. Back to you.
But we were talking about favorite, Liz, and I'm going to get yours in a second.
I don't have a favorite bumper
sticker.
Favorite. People shouldn't have bumper stickers.
All right. My favorite is that my student beat up your honor student. That's a pretty funny one. Have you ever seen that one? It's pretty good. No.
I think the baby on board one is funny because some of them are so small that you have to get really close to you have to be tailgating in order to read it, which is exactly what they don't want you to do.
Right. Like if you can read this bumper sticker, you're too close.
That one too. Yeah. Right. But we saw one in Wisconsin. This is not my opinion necessarily. I'm not saying anything about the stock or the person, but Dan, you'll like this. We saw one in Wisconsin. It was on the bumpers of a Tesla, and it said, "We bought this before we knew Elon was crazy."
I love that. By the way, it's the hottest selling thing on Etsy right now. I just call them MAGA-mobiles, but have a ball. Guys, should we get back to
you brought it up. Didn't you, or did I bring it up?
No, you brought it up. I don't even know why you brought it up. You brought it up.
AAA. All right, let's go. And I apologize because I'm sure there's some people watching or listening that have that sticker. Do yourself a favor. Go out, take it off the car, call in and get rid of your membership and say, you know what? I've evolved. I can actually drive on my own. I don't need your freaking help. AAA. Right, hello. I just got a flat tire on the Major Deegan. Can you come help? Yeah, no. Do it yourself. That's the problem. I mean, that's one of the problems. Like, I can still get out and fix a friggin' tire.
Yeah. Well, when you started doing it on your Chevelle, you know what I mean? Like your first rig.
67 Chevelle, man. I don't know if Amanda or Jacob can get a picture of a 67 Chevelle with hood pins. Yeah. That's a badass car.
Well, by the way, guys, little 411.
Amanda, did she just text me? Hold on, Amanda.
Liz
Hold
does
on.
not have all day. Let's get to
moving on. Amanda just said moving on. Yep. Sorry, Amanda.
Let's get to the call of the day. A couple downgrades on Snap. This is one that I just kind of find pretty fascinating. It's been a good trader in and around its earnings, and sometimes you just wait until after its earnings. It's had like a half a dozen 20% moves the day after earnings, but it often fills in the gap. That's a trade that we've talked about a bunch. Last night, as the news was coming out of their quarter on Fast Money, stock was actually trading up a few percent, and then over the course of the aftermarket session, it sold off. I look at this thing. It did. Look at that. It just fills in gaps. If you pulled it out 5 years on those earnings. So it's sitting here on some technical support. You see that kind of level. It's probably 8.25 or something like that. Below that, I cannot believe this. In late 2018, the stock got down to about $4 or so. This has a $20 billion enterprise value. They still lose money on a GAAP basis. It's got a pretty good balance sheet. Evan Spiegel has these super voting rights. Okay. So if this company is going to sell, he's got to be in agreement on it. I just think about what they're trying to do from a advertising, standpoint, from a subscription standpoint, from an AR, VR standpoint. I just don't know how they make it on their own alone here. And so I just look at this thing and I say, this is in this regulatory environment, especially Microsoft, let's say, is allowed to buy TikTok, this thing is going to get gobbled up in a half a second. And the truth is, it'll probably be in the high teens by the time a bid comes. And I think you see probably $26, $27 deal. Now, why do I say 26, 27? I think that's where it went public back in 2017. So again, no harm, no foul. And that sort of move that you saw in COVID, that just shows you how stupid things got. And that's the last point. I'm just going to tie this together with your Palantir guy. That was the P in the Hope trade. Stupid stocks are stupid stocks. They could get much stupider, but at the end of the day, they always correct. It's just a fact here. So, this thing corrected. I'm sure Palantir at some point in the not so distant future is going to do the same.
Snap real quick before we get to Liz's note. That's one of those things where, you can sort of put it in your drawer, understanding that it's going to be volatile as hell, but it's going to be some binary outcome, I think. So in my opinion, you're risking sort of $9 here, 8.5, $9. And to your point, I think from here, you're looking for a double, if not more. So it's not going to happen tomorrow, but it's one of those names that we 6 months from now will be like, man, oh man, we should have talked about Snap more often.
It's interesting. I mean, this is one, we don't love the idea of suggesting, naked put sales, but this is one where you really do have some decent support on the lower end. And if you were like going to look out, maybe that 8 strike put, if you're going to look out to, I don't know, June, July or something like that, and then you use the proceeds and you buy like an upside call and you try to do it for kind of like zero, premium. And I'm just going to price this up really quickly for a second. The 8 put, it's not great. Maybe the 9 put in July is about 75 cents. You do the math, that's some reasonable sort of premium. And then you could look out on the call side, and then the 14 call is about 75 cents. So you could do a zero cost risk reversal, selling the 9, buying the 14. Your worst case scenario is that you get put the stock at $9 and that's down, I don't know, almost $2 or so.
Okay, we're gonna get to Liz's note. This is from Mike on the Twitter. I believe I'm reading, that's why I'm looking down. I believe doing all these podcasts and TV shows is not easy. Listen, it's not manual labor, but I understand what you're saying. So I think it's important to give you guys kudos when deserved. The 22 to 29 minute segment from today's Risk Reversal podcast was some of your best work. A frickin' men to that.
Was that
Back
the
to you, Dan.
segment?
Well, hey, this is a good opportunity for us to talk about what we've done. So we had the On the Tape podcast, we had the OK Computer podcast. We were doing I think like 4 days a week. One was tech, the OK Computer. The other one, Liz joins us on Mondays, and then Guy and I were doing Wednesdays. And we have a strategist. Other than Liz, for some reason, she won't come with us on Fridays. And so we kind of merged them all together, and we're calling it the Risk Reversal podcast. The first one we did was with Liz on Monday, which is a lot of fun. We have new branding. Maybe Jacob could throw that up here. But what we're trying to do Monday through Thursday is really keep them in a very digestible format, under 30 minutes. So we want to be tight. We're obviously not being tight right here on the market call, but we're going to look to do that a bit better.
It's my fault.
I know. But the point is have fun. Watch this thing, enjoy us, look at the charts, look at the trades. What we're going to do is something very different on Risk Reversal Pod. So today, in 27 minutes, I had a great analyst on with me. We went through 3 things as it related to the generative AI trade, and we're out. So that's it. That's Risk Reversal Pod.
All right. One would think that the volatility index would mirror some of the uncertainty in, let's say, I don't know, trade policy. And this is Liz's first slide. So let's take a look at this, because we're talking about historic volatility or uncertainty, yet it's muted. You know, the flip side of that coin is you're talking about a VIX that, you know, has days, but clearly does not seem to be concerned with this. So there's a reason why you brought this to us.
Yeah, so we wrote about tariffs this week. The article is titled Trading Places, and then there's a section called Trading Stocks, and then the last section called Trading Carefully. But this is the first section. So the Trade Policy Uncertainty Index, this last reading is as of January 31st. You can see that it came down a little bit since that peak in November, but it's still well above where we were even in 2018 and 2019 during the first Trump administration when the trade war heated up with China. The reason for this, obviously, everybody knew that tariffs were going to be a big topic of debate and probably one of the first things that we would hear from the new administration. I think what also happened is that we started to hear rumblings about it, including things other than China, which is what happened over the weekend with Mexico and Canada. So let's go to the next slide. What we thought would be important for investors to keep in mind about tariffs, rather than just pontificating about how this might play out, is where are we most sensitive and where will the market react? So this is just showing us where we're most sensitive. So just anybody who hadn't been paying attention, the tariffs that were proposed for Canada and Mexico, 25%, except for crude oil, that was only going to be 10%. And then for China, an additional 10% as well. Mexico and Canada have been paused for a month. They've been paused, not aborted. I want to make that clear, which is why there was this relief in the market. But you can see the industry groups that are most exposed to Canada, China, and Mexico on this chart. So we're looking at crude petroleum. There's a bunch of sort of tech and tech adjacent stuff in there. And then we've got a lot of automobile stuff that typically falls into the discretionary category. Some of it will fall into industrials. So, and then you even see some of the discretionary stuff, dolls, toys, games, things like that. So some interesting stats here. 16% of US GDP is imports. Okay. Now we report it as net trade. So that's imports and exports. But if we just take imports, 16% of US GDP is imports. Canada, Mexico, and China make up more than 40% of those imports. So if we were going to slap tariffs on just those 3 countries, those are our top 3 trading partners, just those 3 countries, whatever the average tariff is, that's going to affect 40% of the imports that we take in. So the important thing that we were trying to suss out in this column, let's go to the next slide, was how does the market take this? Because if we're going to slap tariffs on all of those goods, 40% of our imports, the market has to either say, okay, that's fine, consumers will absorb it, maybe they'll take money out of savings and prices will go up and everything will still be fine. Businesses will absorb it too, maybe they'll pass it through, or maybe they'll use the cash they have laying around to pay for higher input costs. That is not what happened. So what you see on this chart, this is just Monday versus Tuesday. Monday is the blue bars, Tuesday is the magenta bars, and this is just by sector. So you see on Monday, the worst hit sectors, tech, consumer discretionary, industrials, right? So we've got sectors that are pro-cyclical and pro-growth getting hit the hardest on Monday. And then on Tuesday, the relief rally in energy, communication services, tech, and consumer discretionary. So this tells us that the market decided consumers would have to make some trade-offs. They would probably stop spending as much money. That's why discretionary got hit so hard on Monday and had a relief on Tuesday. And it's telling us that companies also would have to do some pulling back or cost cutting based on price rises. So this created a growth scare. And there are some narratives out there that are saying, oh, it wouldn't create inflation. It wouldn't really affect growth. It would be better for the US. If it all worked out perfectly over the long term and all of that manufacturing came here and so on and so forth, perhaps. But in the near term, the market is telling us, and I think the market is smart, the market is telling us that this would be a growth problem for our GDP. It would be a prices problem for our inflation. And it was afraid of, again, the stagflation word.
You summed that up extraordinarily well. And, you know, what this chart suggests, I mean, here we are on Wednesday and we're back to sort of square one, but the volatility over the last couple of days, obviously, is, I think, Dan, is something we're going to be seeing a lot more of. Now, again, a VIX at 17, that does not necessarily suggest that, but on the back of the VIX, some of these individual names have been, the moves both up and down have been extraordinary. And I think that's what Liz is talking about here. So, you can say, you know what, I can stomach the day-to-day volatility because at the end of the week, we're going to be back where we started from. Yeah, maybe. Or, this suggests, something more is on the horizon in terms of prolonged volatility with more moves up and down. So we'll see.
Yeah. So before we get to Butters, that was something that we've been tracking with him over the last couple of weeks or so, that kind of, volatility we've seen in and around events. I just want to bring up one name that reports tonight after the close, and it's Qualcomm. And here's a company that gets 2/3 of their sales from outside the U.S. They are not exposed the way a lot of these other semiconductors are to, let's say, data center and generative AI. A lot of their chips go into handsets. Some of their biggest customers, I think Samsung and Apple, make up 40% of their sales. 40-some% of their sales come from China. The two other big customers are China Unicom and Xiaomi. These are obviously Chinese handset makers. This one guy, it just looks precarious to me. And again, it's not the chart that bothers me. It just, the exposure. And it's not just that they have exposure to China, is that the handset market is weak. Last year it grew, I think, 2% year over year, and iPhones did not grow. They were flat. And then the guidance that we got from Apple, China is a huge problem from Apple right now. So this is one that should make you nervous if you're long. I mean, maybe they give, better than expected, guidance. I just can't see how it happens. So thoughts there, Guy, on the Qualcomm really quickly.
Well, there's a saying, I'm going to sit this one out. That's, you hear a song that's sort of shitty and you don't want to dance to it. And I don't dance, period. So it doesn't really impact me. But last quarter, I thought Qualcomm set up extraordinarily well into the quarter, and I thought was a real good chance we're going to see levels that we last saw in June. And they reported earnings, and the stock was off to the races, and I was patting myself on the back. And then the next day, this thing started to cascade lower. Now we're back to those levels again, and I'm with you in terms of some of the headwinds they're facing, but the fake out last quarter really had me scratching my head. We've gotten back to those levels, but the headwinds haven't abated. If anything, they've gotten worse. So I'm just going to sort of do a wait and see on this one, but I'm glad we brought it up.
Yeah, no doubt. Just really quickly, so we went through Liz, her fine work there. You know where you can get that blog post? We get
a lot of hyphens, a lot of dots.
A lot of hyphens, but let's just do it. They're going to throw it up there. This is SoFi.com/ I can't do it without the thing.
Come on, Jacob. He's hanging you out to dry.
SoFi.com/ that doesn't even do it.
Just go to the SoFi website. Just go to the homepage.
Just go to my Twitter.
Go to Twitter.
Yeah.
Are you still on Twitter?
Yeah.
Oh, geez.
Can I tell you something? What does that even mean? That's one of the first things I do every morning. I look to see what Elizabeth tweeted. Her tweets are, because they have little pictures and stuff. They're fantastic.
Yeah, we do lots of pictures.
So the SoFi blog, it comes out every week. We get a preview of it. We appreciate it. Liz, do you have any podcasts coming out? Because you have a podcast also.
I had a podcast that dropped last Friday with Brian Portnoy. He talks a lot about behavioral finance. It was really, really good. I expected him to be good, but he was extra good. So that was the latest episode that came out. Go give it a listen. It's called The Important Part. You can find it in all of your, what do you call them, Guy?
Your favorite
stores.
Podcast store.
Yeah, you can find them there.
Important Part.
Yeah.
I really like that name, and I like the guests. You've had like a really nice breadth of guests over the last couple of years. A lot of strategists, but a lot of folks doing some other things adjacent to investing. All right, Guy, you teased it at the top of the program. If it is Wednesday, it's not just Liz Thomas, okay, which we obviously enjoy, but it's also John Butters. He is the senior earnings analyst over there at FactSet. He writes every week the earnings insight. It's a blog. You can have it to your email box. Maybe Jacob's got this one ready to go here. Well, there it is. You just go to that blog. We don't have the URL there. But John is tracking some interesting stuff. Guy, it kind of ties in a little bit to what Liz was writing about in his note this week. The term tariff or tariffs have been cited on the Q4 2024 earnings calls of 98 S&P 500 companies to date. Now, 500 companies have not reported. I think we're probably half to 2/3 through the S&P 500. Now, Liz, I'm going to ask you first. Does that surprise you? Let's just say there's 250 companies that have reported that only 98 have talked about tariffs.
No, I don't think it surprises me because it was still speculation when companies were finishing up their Q4 results and probably writing some of this commentary. And remember, this news didn't actually come into effect until last weekend. So anybody who had reported before last weekend was still speculating. So I don't know that it surprises me. I think the part that is maybe the most telling is that industrials, which I know you're going to get to, industrials being the highest frequency of those reports. And that probably will continue to be the case. I imagine we'll start to hear more from consumer discretionary companies as well. But again, we're at a point in earnings season where we haven't heard very much from all those retail and consumer discretionary names. But I would expect this number to keep climbing, particularly in those sensitive sectors. And if you go back to that chart that I showed where we're the most sensitive, what are the imports that we're most sensitive to? I bet there's going to be a direct link to Butter's work in what companies are reporting tariffs as an issue. You're going to hear it from energy companies, probably hear it from technology companies. You're going to hear it from industrials because of autos, discretionary because of autos, and other consumer goods.
I'm glad we did this side by side because she's exactly right. I mean, materials, industrials, those are the ones you can hear it the most from. Makes a lot of sense. And if you go back to Elizabeth's slide, you can do that on your own. You'll see that those are the most heavily. Yeah. So it all lines up, and they're right to be concerned. Again, I don't think the market is taking this into proper consideration, but what do I know? We'll see. But here we are, as I've been sitting here, I have an S&P that's gone positive on the day. The Dow's having a day. The S&P at 60.50, Dan, is within probably 1% or so of the all-time high of 61.28-ish. So a lot to be excited about if you're a market participant, but still, all the things that I've been concerned about haven't gone away. They've just gotten worse.
Yeah. And one thing I'll just say about the industrials, so they're citing tariffs at 29. That's the highest number of those 98. Look at GM. Let's just pull this up because autos are like squarely in the face of this, at least as it relates to Canada and Mexico. And GM had that disappointing earnings result last week, but then it got hit pretty hard, on the tariff news. It just hasn't bounced, and again, I think it's really interesting in a day, like you just said, Guy, we made up some of this ground in the S&P 500, and you like to look around and you see what's participating, and some of these names that got hit hard on Monday haven't really bounced back. So Liz, if there's one group, before we get out of here, one group that's taking it on the chin with this tariff news, and again, we don't know how this is going to shake out over the next few weeks. They kind of, kick the can down the road with our allies for a month, and the China stuff is still going back and forth. If there's one group that got really hard, what would you look to buy on the dip on the tariff news?
I don't expect that healthcare would get hit really hard, but I am still very constructive on healthcare. And you know what? It might give us an opportunity in software. I talked about software earlier. If you see software come down just by association with the rest of the tech sector, I think that's an opportunity.
Elizabeth, well done, succinct, getting us out on time. It's always, yesterday you could have seen her on one of those afternoon shows. Which one was it?
Closing Bell.
Closing Bell. It's the Closing Bell.
Show, yeah.
It's
one of the great shows. It's right up there with the HTR, which is my personal favorite. And there's such a compelling group on that show. And they're also likable, which makes it so easy to watch. That show goes by like that.
Well, that is the genius. CNBC for years before you started doing Fast Money, in 1984, they really just had shows with anchors, and they had a bunch of guests. And
anchors is the right word, by the way.
Yeah. And then at some point, they
anchor it down.
They decided to take a basketball team of 6'2", like guys like Guy Adami, and make a panel show,
right.
and
throw that shit up and see what happens.
Yeah, exactly. So there you go. You got the Fast Money. At someday, guys, Liz Thomas will join us.
No, she's made her choices. No doubt about it.
Well, somebody's got to play point guard. If there's a bunch of 6'2" guys on the basketball team,
you
need a 5'4". Yeah, just quick, get in there.
Yeah.
All right.
I'll tell you what. I'll go. You pick another person. I'll play 3-on-3 with you any day, sister. You get, and just any of you jackasses out there think you're gonna mess with EYT now.
That's my dad was a basketball coach, right?
Yeah,
you know how many camps I've been to?
Yeah, she's got a handle.
You know how many drills I've run?
Amanda's like, God help us all. I'm sorry, Amanda. Amanda's feeling better, which is good. Jacob in the house, Timmy, Bill Hockman, who was laughing at my AA, AAA thing. AAA. It's fucking unbelievable. That's it. That's it for me. I got to go to the. I got to put a tie on because I'm headed into New York City for the Fast Money Show, 5 o'clock Eastern time.
All right. See everybody. Thanks. Thanks, Liz.